So I'm answering pension questions from pension locations, where a better place to do it. And one quick question that comes up a lot is, Alpesh, why is my fund manager, an IFA, only giving me 4% per annum when I keep reading in the press Meta's up 30% and NASDAQ was up 55% last year and the S&P 25% and Microsoft keeps going up? Surely these aren't risky companies. And my IFA keeps saying two things. He says, first of all, they're risky companies, look how volatile they are. And the second thing, he says, don't worry, you've got some in your pension. And so let's just put a bit of a truth to some of that. They're volatile in the sense that they go up a lot. Of course, what you're really concerned about is downside volatility, and to which they might rightly point. In 2022, Meta fell 80% in a year. The reason that an IFA will use that as an excuse not to give you more of what you want, which is higher returns, is because they can't go into cash. They can't say to you one year, look, this year you shouldn't have stocks. How would they know? Well, pretty easy. You'd just say if it drops 10% off the highs, we'll go into cash. And that was a pretty good trick which works with most of these tech companies. And then in terms of getting back in, you can have a simple rule for that as well. Anyway, the problem is, and it might not be 10%, you might keep it at 15%. The problem is the IFA is trying to sell you something. He's trying to sell you funds, and he can't say to you cash is the right thing, as I could say to my clients in 2022. Cash is now the right thing, I'm afraid. And it turned out for the whole year. I didn't know it was going to be for the whole year, but it was. The other reason they'll say, well, don't worry, to placate you, you've got some of this, when in actual fact, you don't really have some of it at all, is they'll say, look, I've got you a North American fund, now shut up, go away and pay my fees. Well, the problem with their North American funds, and I've looked into them, is when they go through them, and when I go through them, what I discover is they've actually got, yes, all of these stocks, and they've got such a small amount in each one just to keep you quiet that it doesn't make a difference. You don't get the gains. And then you might say, well, wait a minute, why have they got them then at all? Well, one, to shut you up, and two, because they know they can't ever go into cash should those companies drop. Why can't they go into cash? A couple of reasons. What the hell else are they going to buy? If those are doing poorly, what else is there? Because they make up such a big component of the broader market. And why can't they go into cash? Well, because under their mandate, they've got to hold at least 95% in equities. So you end up with that fundamental problem that you're asking a person with a massive conflict of interest, why are we not getting the returns? Because they can't deliver them to you, because it wouldn't be possible for them to with the tools at their disposal. That's the fundamental problem, and I'm afraid it's the reason why at 4% a lot of people aren't going to end up having a pensionable life that they thought they were going to have. It's just a sad state of affairs of the pensions industry.